Fausto Puglisi, president of Cyber Trading University.
Most people always focus on the past, where as a professional day trader, we just focus on the future. You can do very well in trading, and you don't have to have a good amount of movement for the stock to go up.
Welcome back, everyone. My name is Fausto, and you're at another episode of Cyber Traders. And I have a new guest today. I'm really excited to have her on and looking forward to hear her thoughts on the market and teach and educate us a little bit more. We got Carley Garner here, and she is live from Las Vegas, a little early. Thanks for waking up early for us. Hopefully it's not too early over there, Carley, but how's everything going?
Good. I actually start work at 5 a.m. I live on the West Coast. I work on East Coast hours, so no big deal.
Yeah, you know what? We train a lot of people. A lot of people from the West Coast are here too, and I mean, we had some people even down to like Hawaii that came down. So you can imagine how early that is. But you know what? I kind of like the West Coast a little bit. You basically do like two jobs. I mean, like think about it. You start at 6 a.m., which is 9 o'clock, or even 5:30, and you trade the first hour. You're done, and you get the rest of the day to go. So that's awesome. So anyway, what's been going on with this market a little bit? I know you do a little bit more of the commodities, futures, and options, Carley. So what are you seeing that's been going on in this market, and how do you think people should be trading it?
Well, there's obviously no shortage of volatility here. I mean, we've seen since April, basically, we've seen years worth of moves in hours or days. So it's been challenging. Luckily, we haven't been caught too off guard on, because it's hard to be not in the wrong place at the wrong time with some of this stuff. And luckily, we've been kind of lucky. So I'm knocking on wood, but it's been fun. I think our approach is probably a little different than maybe what a lot of your followers use. We generally stick to options, and the reason being, I mean, trading is it's a mental game. We all know that. It's really not about your strategy or even the market or your analysis. It's more about how you handle yourself when things are going good or things are going bad. Me personally, my personality works better with option trading because I have more room for error. I could be wrong, and the way that we structure our trades, I could be wrong, and actually we break even or even make a little money being wrong. Where we get into trouble is if we're just dead wrong, like we're really just off the charts wrong. That's where we get into trouble. But from a mental standpoint, it gives me the ability to kind of write things out and be there for the times that we are right, and basically capitalize. I don't want to say capitalize because we all know it's trading, speculating. There's no guarantees, but the goal is to capitalize on some of these big moves without losing our shirts. And luckily, we've had a decent year.
Yeah, it's been actually a really good year so far. I mean, we had a couple of nice little crashes. We had Liberation Day. Every day is always a new adventure, I tell everybody. But tell me a little bit about your career. I want to know a little bit about your story. What got you into this industry? Where'd you come from? And how did you fall into the options, commodity futures? Everyone has always a fan, especially being on West Coast.
Yeah, so there's no real grandiose plan. It was all just kind of, I stumbled in. It was a little bit of serendipity. In college, I got 2 degrees, one in accounting, one in finance. I started with accounting and I realized I hated it. It was not for me. So I went into finance and I thought I wanted to be a stockbroker. But as it turns out, I didn't really like stockbrokering either because a lot of it was basically just selling loaded mutual funds, or at least that was my experience during my internship. And it just wasn't for me. So I ventured outside of my comfort zone, found a little shop here in Vegas that traded commodities, and I've been doing it ever since. And honestly, I think wasn't my plan, but it worked out very well for me. It's not the easiest path to take, but I love getting up and going to work every morning because every day is different. It's definitely not mundane.
Well, you know what? It's exactly what happened to me too. We all always kind of like, to get into the door, we all try to end up become a stockbroker. I hated it. Like you just said, just a glorified salesman selling stuff. But it did open the door to kind of let you see like, well, you know what, this business is endless. I mean, like you just mentioned, there's accounting, there's attorneys. But what I guess you fell into where I fell into it, where you love the trading aspect of it. And I always find that's where the brokerage firm makes most of their money, especially living here on Wall Street, and seeing some of the biggest brokerage firms like BlackRock or Goldman Sachs was the godfather, to me back then. just see how they do it. But for you, I mean, being a woman entering this male dominant space, I mean, you jumped in about 2024. What do you
Right.
find has been the biggest challenges? I mean, we train a lot of women too, and I find women are very good traders. They're very disciplined. They don't have egos like a lot of men do.
Yeah.
But what are the challenges that you find, and how have you been helping women get into this business?
Right. Well, I mean, to be honest, from a career standpoint, not trading, but actually just the brokerage side of it and furthering my career in the business, I think it's been an advantage to be a female. And I will say, as somebody that deals with retail traders and clients, they're probably less inclined to yell at me if something goes wrong than they would be a male broker. So to be honest, I think I've had it pretty easy.
Okay, yeah, that I agree.
But I will say, I think in general, this is not a blanket statement. Well, it is, but there's obviously exceptions. But I do agree that women probably are a little less aggressive in their trading, and that means they're probably going to make less money, but it probably means they're going to lose less when things are going wrong as well.
So now then how did you like obviously you said you fell into that business because you're in Las Vegas and whatever, but like is there any do you explore any other markets, or are you really good just trading more that futures options type of a market?
So we are a brokerage firm. We provide a lot of educational material and trading guidance to our clients, but our bread and butter is not selling education or books or anything like that. Our bread and butter is actually commission on the brokerage end of it. So with that said, we're a true commodity firm. We only deal in futures and options on futures. We don't offer stocks or crypto. Well, we offer crypto futures, but that's a different animal. So what I'm trying to say is, there's a lot of brokerages out there that try to do everything, but they're probably not really great at anything, right? They're kind of good or mediocre at most things, but they don't specialize in one thing. Where we excel is because we only offer futures and options on futures, we're streamlined and we can offer a much more elevated service. We answer our phones. I know that sounds kind of crazy in today's world, but we answer our phones, we answer our emails very quickly, and you can get a hold of us and we know exactly what the answer to your question is. Or if we don't know it, we can get it pretty quickly. If you've ever called a bigger shop that offers stocks, futures, a little bit of everything, most of the people that are answering the phone have absolutely no idea. They can't tell you when the market's open or close. They can't tell you margin rates. They can't really tell you much of anything. So because we're streamlined, we offer a much better service, which includes lower margins, more strategy offerings. For example, a lot of brokerages won't let people sell options or trade option spreads. We do. I'm not saying option selling is for everybody, and there's a specific way to do it without getting your head ripped off. And even if you do it right, you might still get your head ripped off. But we do allow people to, they're adults. They can choose to do those sorts of things with us. Yeah. So that's what we do.
So, I had a lot of CEOs of brokerage firms on here, the CEOs of like, Tasty Works, Tom Sosloff, a good friend of mine. I mean, he's in futures options. I had Jim from TradeStation. I mean, I've done Thinkorswim, all of them. What makes you different than all the other brokerage firms out there? Like, why would anybody come to you? Now, listen, there's so many brokerage firms out there, and everyone always thinks you got to deal with the big brand name. And I tell them you don't. I mean, a lot of it has to do with customer service. But what makes all of you different and separates you from the big boys?
There's a few things that stand out with us. Is number one, our product offering is much bigger than most of the firms that you just mentioned. Most brokerages will limit you to what you can trade to maybe like the most liquid 5 or 10 commodities, and they won't give you all of the option expirations. For example, a lot of the commodity options have daily or multiple weekly expirations, but if you're trading with some firms, you pull up an option chain, you might only see the monthlies. So we offer everything that the exchange offers, we offer. And where that comes in handy is you can pinpoint your hedges. So for example, if you're a futures trader, you can buy or sell futures and then choose to buy or sell an option that expires today or tomorrow to hedge it or to protect it, as opposed to placing a stop order. With some brokerages, you'd be forced to buy a monthly option or maybe just the Friday weeklies, and they're more expensive, so your risk is higher. So we offer those sorts of things. Also, we charge span minimum margin for our option traders. Most of the strategies, if we do get into it today, I'll kind of explain what I mean by that. But most of the strategies that we use, we're trying to use the market's money to pay for our speculation. So, for example, today we went short the euro using options. We sold a deep out of the money call, and we used that money to pay for a put spread, a vertical put spread in the euro, where we have like, I want to say about 600-700 points to be wrong and still kind of break even at expiration. So we're shifting our risk up there. But if you tried to do that with some brokerages, they would charge you 5,000 or 6,000 in margin, where we charge the exchange minimum, which is about 2,200. So that's a big advantage to anyone that's trading options.
Now, is this more of a fund where they open an account with you and you trade it, or they're trading their own account individually, privately?
So we offer discount online trading, and we also offer full service. I don't
Oh,
manage money for people. I've done it in the past. It's no fun, to be honest. It
yeah.
stresses me out. Clients stress me out because for example, um, let me just, for example, we were bearish crude oil, and with all the stuff going on in the Middle East, we actually added to our position, sold more calls, bought more puts. And nobody was stressed out because I put out the recommendation and then the clients opted to either participate or not. But if I was managing somebody's account and they were very uneasy about that, it would have created undue stress for all of us. So I don't really manage money for people. But what we do, whether our clients choose to trade online on their own, meaning they're basically entering all their positions, or if they trade broker assisted, which there's not many of us out there. There's not many full service brokers out there anymore. But believe it or not, that's what we do. We accept orders via telephone, email, text message, and I put the recommendation out, and they either respond with yes, let's do it, or questions they have, and then I execute it for them. So we do that sort of service. And of course, we also have clients that just trade their own strategies, and that's perfectly fine. Nobody has to do what I'm telling them to do. In fact, we don't encourage it. We just say, hey, here, this is what we think is a good idea. Here's the risk reward. Here's why we think it's a good idea. And then they choose whether or not to participate or to do their own thing.
Now, regarding Carley, I mean, like, listen, I'm an equities trader. Okay, I more day trade and do more swing trade, do a little more options. I always hear the risk that comes with commodities, right, and with futures trading, and there are people who lose a lot of money on it. Why should I not be scared of commodities? Why do people are very fearful of trading about commodities? I mean, like, what makes what if I was you to drive me back in and say, hey, you should try it this way? Because I don't think too many people know too much about the commodity part of it. And I do monitor the commodities at a certain point, but what separates that exchange than all the other exchanges?
So to be fair, anybody that trades commodities should be scared. That's the point. It's not, it's not easy money, that's for sure. And it's not for everybody. And I always tell people, even though I do this for a living, it's not for most people. Most people shouldn't be trading commodities because it's going to ruin their life. Maybe not financially, or maybe so financially, but stress them out. If it's ruining your vacations and your family time, it's not worth it. So for those people that have risk capital, and what I mean by risk capital is money that you can put in a commodity account and you can afford to lose without changing your lifestyle. If you have that sort of money and you want to, have a speculative nature, it might be for you. I will say, obviously, I don't want people to lose their money, but it should be, you don't want to put your entire 401k in a commodity account. That's what I'm trying to say.
Right.
Commodities have a bad rap for a couple of reasons. One, because futures contracts are leveraged. Future commodities in general, like if you look at the price of crude oil or gold or anything else, they're not necessarily more volatile than stocks. The difference is commodities are leveraged for everybody. Whether you're trading a $2,000 account or a $2 million account, you get the same leverage. So
explain that. So I think some people understand, like, listen, I do classes. Some people understand what the bid and ask is. You know what I mean? What do you mean by leveraged? What exactly?
So by leveraged, I mean you can make or lose money based on a contract with a small amount of money. Okay, let me reword that. For example, the margin on gold right now is about $16,000. But if you purchase a gold futures contract, you're actually making money on about $350,000 worth of gold. So for $16,000, you're controlling $350,000 worth of gold. It's not unlike when you buy a house and you put 5, 10, 20% down, but your house value is fluctuating. Regardless of how much money you put down, the value of your house is fluctuating accordingly. And so you could wipe out your entire down payment or double it. The same thing goes with commodity trading. Now, what people don't understand is they think that because they can, they should. They think if they have a $20,000 account, they should buy one gold future and just let it ride. Well, the reality is you can easily wipe out your account on a one lot in gold because of the leverage. Gold only has to drop, just rough math in my head, 5% to wipe out your account. Maybe not even that.
So you basically, you kind of explained to get everyone, because I'm glad you brought that up, because I think some of the people here have this problem with anything, because we deal with it even with day trading. So it's basically margin, right?
It's margin. Yes.
Yeah,
it's margin.
Margin. And what you mean by leverage, being high leverage. And I think this is the problem that we have with Forex traders. Forex traders, got into it back in the day, 20 years ago, 50, I really took off back in 2000, I would say, and used to be able to get like 100 times buying power. So, used to, like, for $1,000, you'd be able to buy 100, even some of them give you more than that, Carley,
Yeah.
right? So, and like you said, you could wipe out your account immediately. But, the difference of Forex, I mean, it doesn't really move that much. So, you need a lot. So they gave you a lot of buying power. So it's highly leveraged. How much is it leveraged?
Every commodity is a little different, but most are 10 to 1 or 20 to 1, somewhere in that ballpark.
Okay.
The thing that I try to teach everybody is you don't have to use the leverage. It's there. If you're very aggressive and your intent is to just kind of, roll the dice, for lack of a better term, fine, go for it. But if you really are trying to make money in commodities and you're trying to, be a responsible speculator, you can reduce your leverage by overfunding your account. And what I mean by that is, if you're a gold trader, instead of having a $20,000 account, you can have a $350,000 account, buy one contract, and you've eliminated all the leverage. Now, I know most people don't have $350,000 sitting around to buy gold, but there's micro contracts. So you can trade a micro gold. The value of that contract is closer to $30,000, $35,000. And so you could have a $35,000 account, buy one micro gold, and you've basically bought 10 ounces of gold with zero leverage. And unless gold goes to zero, you're not going to wipe out your account.
But what's the spreads on those? Are the spreads any different than like an equity stock or anything else? Are they bigger? Are they smaller? Because like gold, like some people don't realize it, and I try to explain to them, because I own gold myself. I actually own the bullion of it. And where's gold trading at? Was it 30, almost 3,500, right? 3,400, something like that?
3,350, yeah.
3,350. Okay. So some people don't understand that that's what you could sell it for. That's not where you could buy it for, right? You have to pay, I think that's spot, right? So you have to pay, $50 over spot, right? Sometimes. So just for you to break even. So on the commodities, it's the same thing.
No, not really. So if you're talking about gold bullion, it's a whole different ballgame. You're correct. There's a spread. It's usually, it depends on the dealer, but you can kind of expect, but by the time you buy and sell gold bullion, you probably took a 5 to 10% haircut, to be honest. That's just how
that much. You think, wow. I mean,
yeah, it's pretty big. Maybe 10% might be excessive, but it's not convenient. Plus you have to pay for shipping and all this kind of stuff. But in the gold futures market, the bid-ask spread's a tick or two. So if you're trading a micro, it's like $10, $20. And again, you're trading a $30,000 contract roughly. So it's super, super liquid.
It's super liquid. Okay.
Yeah. From Sunday night to Friday's close. So 23 hours a day, roughly. There's an hour in the afternoon that it pauses, but almost around the clock, you can buy or sell with a very, very tight bid-ask spread.
The one thing I don't understand, about these, these leverage plays, like these, having with the margin and stuff like that. Like in day trading, they passed a law back in 2000 that, because we had the internet bubble, if you remember back then, and a lot of people blew up their accounts. So they passed a law and they said, okay, you got to have minimum 25,000. It's called the pattern day trading rule. You got to have $25,000 in your account and you get 4 times buying power, which I think is like the stupidest thing in the world, right? I'm like, first of all, why do you have to punish people to come up 25,000? Because they're worried about people losing money. And then here you are giving them the buying power. I always felt like, you should be able to trade your cash, and, maybe 2 to 1. But like you said, if it goes against you, you could blow up your account. Is there any policing when it comes to that, or is leverage different on all different different types of commodities, or
So the difference is when you are trading in the stock market on leverage, you're borrowing shares from your brokerage. In futures, we're just trading paper. We're just trading obligations, and it's the exchange that guarantees it. So it's not your broker. Like if you buy or sell gold from in an account with us, we're not taking the other side of it. Where you're just your orders being facilitated to a centralized exchange, the CME group in most cases. And the exchange guarantees every transaction, and they do that by requiring every trading account have the certain amount of margin to cover losses. So it's a much different animal. There's no interest charges, and there's no day trading pattern rules, or there's none of that. It's you can buy or sell any time of day as long as you've got the margin to do it.
what are the hours, what are the hours actually for trading on futures? What are the best times to trade? Worst times to trade?
So the most, if you're talking stock index futures, let me just add this: the reason the Nasdaq and the S&P futures are so popular is one, because there's no day trading rules. People can buy or sell freely as much as they want, which can get them into trouble, but they're adults, and if they choose to do that, I mean, nobody's going to stop them.
Right.
And the futures markets are open during earnings seasons, when earnings are reported after the bell. The futures markets are open, so people can react to that and hedge their portfolio accordingly. So for those reasons, the Nasdaq futures and the S&P futures are very, very popular. They basically trade the most active time of day for most contracts, and specifically the stock index futures, are basically while the New York Stock Exchange is open. So those are the most liquid hours. But the futures actually open at 6 p.m. Eastern time, and then trade through 5 p.m. the next day, and then they do it all again the next day. So 23 hours a day, you have access to liquid markets from your cell phone, from your computer. It's really, really convenient.
All right. So getting back to what you said earlier. So the main reason why, like you just said, a lot of people, I mean, you've been there for a long time, and you see people blow up their accounts. See people do really well on it. I always like to put the fear in God on someone when I teach someone before we actually go out there and do it. So the main reason is the leverage, right? That's really one of the reasons why it becomes very risky. And I get it. I mean, it's like options too. I mean, some people don't realize you got three things to beat. You got time, commission, and a spread,
Right.
But over the years, what has been the most common emotional pitfalls that you see that traders fall into?
Okay, so I'm going to clarify the reason commodities are risky are not necessarily the commodity markets themselves, but the fact that people don't understand or appreciate the additional risk that comes with leverage, and they don't handle it properly.
Right.
So it's not the markets themselves, it's how people approach the markets. They're looking to get rich quick. Not all of them, but this is kind of the mindset when people come to futures. That's what they're thinking in their head. How much can I make? Not how much can I lose? And that's the problem, and that's why a lot of people lose. I'm sorry, what was your question?
No, listen, I like your metaphor. How you explain about buying a house. It's like saying, it's like the subprime days, right? It's like putting no money down and you buy the house, right? But if the house goes down in value, who has that money coming out of your pocket? If you can't afford to put money down, you really can't afford the house, right? So, but I was saying that the pitfalls that you find that new traders fall into,
right?
And that,
okay. Yeah, thank you. I apologize. So most people get into trouble because, number one, they're utilizing leverage to the maximum extent that they can, and that's just a recipe for disaster.
Right.
When you're trading, you have to have you can't expect yourself to be perfect, and if you do, you're probably not going to win. If you're using all the leverage, you're going to have to be perfect, otherwise you're going to blow up your account. So that's one, is just using too much leverage. In the same idea, trading too big a quantity. For some reason, people they look at their account and they see what the margin requirement is, and if they have enough money to buy 10 contracts, they think that's the way to do it instead of just buying one. So
Right.
Keep your quantities low, trade below your means. Again, focus on how much you can lose, not how much you can make, and you're going to be a lot better off.
Is there a reason why they do that? Can't they they know, because it happened to us back in 2000 with the financial crisis. Do you think they would ever adjust the requirements, or they just because they make so much money doing it?
Well, that's a good. So there's two aspects to this. It gets a little bit complicated, so I'm going to try to keep it simple. In futures, there's two entities setting margin rates. The exchange sets a certain margin rate. So let's take the E-mini S&P. Right now, the E-mini S&P margin is very high because we've just witnessed all this volatility. The exchange requires $24,000 to trade one E-mini S&P. which is a good chunk of change for most people that are speculating.
Right.
However, the exchange only measures margin at the close. So I just mentioned we traded from 6 p.m. around the clock to 5 p.m. Eastern time. At 5 p.m. Eastern time is when you have to be within exchange margin. What you do between 6 and 5, those 23 hours, is between you and your brokerage firm. So the brokerage firm actually sets day trading margin. So what happens is most brokerages, I'm not a big fan of offering deep discount margins, although we do offer it for traders, but I try to discourage it because the odds of people making money when they're using that kind of leverage is very slim. But there are brokerages out there that will let people buy or sell a E-mini S&P that has a margin required at 24,000 if they hold to the close, or $750 to $500, which is like basically 10 to 15 points in the S&P. The S&P just drifts 10 to 15 points without any type of news or trend. I mean, that's really just a recipe to blow everybody's account out. So that's the problem, is people not only utilize the leverage that the exchange offers, which is very significant, but then they double down on that and use day trading margins that their broker extends to them. And that's where people get into trouble.
Carley, it's funny you bring that up about people blowing up their accounts and stuff like that. And I want to go into the strategy part about it with you a little bit more, because I know you're busy. I don't want to take too much of your time, but like, I always find that some brokerage firms, I hate to say it, but there are brokerage firms that trade against clients and actually take in the bet that you are going to lose, and it give them all that leverage. I know brokerage firms in the past, I'm not looking to name some names, and some people here could read up on it, but they'll basically give them that leverage and they'll take the other side. And that's what a lot of online brokers do. And then if it goes against them, they have these algorithms, and it obviously buys back the stock if it goes against them or whatever it is. But if they know when they're in a negative, they're basically holding it and they're running it, and which is fine. And nobody has to look at it. Listen, someone's a trade against you. I mean, that's part of doing business. That's why people do it. I always try to tell everyone this. I'm like, why do brokerage firms give you free tickets? Because they like you? You know what I mean? Like, there's no such thing as free lunches, but apparently there are people that do think there is. They're like, wow, the tickets are cheap. Let me go there. I'm like, well, they would charge me $7 and that charge me free. I'm like, well, do you ever ask how do they make money on your trade? You know what I mean? So, and there's some of the reasons to it.
Yeah, no, I'm glad that you mentioned that, because I did fail to mention a few things. So for starters, in futures, it's different than that. Futures traders are never trading against their broker. It's always going to the CME exchange, and some other trader is being matched with them. It might be a market maker, but it's not the brokerage firm itself. But you're absolutely right. If you're trading stocks or Forex, that's exactly what's happening. The brokerage is taking the other side. And in futures, I failed to mention, you're right. The incentive for brokerages to offer discounted margin is that the more people trade, the more revenue they generate through commissions and exchange fees. The exchange makes a lot of money on fees. Each futures contract that gets executed, depending on which market you're trading, the exchange, not even your brokerage, the exchange is making $2 to $3 on those. And that's in addition to commission you're paying your brokerage. So everybody in the industry along the line is incentivized to give you lower margins so that you trade more. So that's absolutely correct. And you have to be aware of that. Don't fall into that trap.
Oh yeah, I live here in New York. I do a lot of presentations for NASDAQ, and like NASDAQ is, the way brokerage firms make money, like in New York and NASDAQ, I tell everyone is like when companies go public, because and I know people on the inside that work at the exchanges, because they have to file, they have to file every quarter, earnings. I mean, it's very expensive to be public. Not even just the compliance part about it, but there are fees that come along about to be public. And, it's so funny. A lot of people, Carley, don't know this, but like, if you notice, there's not a lot of companies going public as much. So what they're doing is they're making these stocks, they're making them into ETFs. Like Tesla, for example, you could trade, there's like 30 different ways you could trade Tesla. There's high yields. There are, there are shorts, there are option shorts, there are longs. And they do that because the more they do that, the more the exchange makes, like you just said. And I'm bringing it up, regarding about the commodities part of it. Like, brokerage firms don't make as much money. The exchanges make all the money. That's why they want to, have them come out with these ETFs, give you the leverage, because if you don't trade and these companies not around, they don't make any money. You know what I mean? So they're not stupid. you know?
No, not at all. I mean, the financial industry is not here for us to build wealth. We want to think of it that way, but the reality is it's a business. Everybody's trying to, pickpocket everybody else. I will say this also when it comes to, I hear a lot of people like when somebody calls to open an account or emails me, the first thing they ask is what do you charge in commission? And they also mention, yeah, but I can trade stocks over here for free. They don't charge me commission, or I can trade Forex with no commission. But people don't understand, like in futures, because we are not the other side of the trade, we're charging an upfront commission. You see it on your statement, you know exactly what your cost is. But if somebody's giving you free commission for stocks or Forex, it's not because they're a charity, it's because they're making the bid ask spread. So you can buy it at one price, you can sell it at another price. Difference is what the brokerage is making, and it's usually $20 to $30, not $5, which is what we're charging. So people have to be really, really careful. There's no such thing as free. Somebody is always making money somewhere, and just be aware of it.
Yeah, and I also tell them too, Carly, is that some people, I said, look at the back of your account statements, because then they do something called payment for order flow, where they'll actually sell it to another brokerage firm and get paid not just the beautiful, courtside tickets at the Knicks game and stuff like that, but they're actually paying them a lot of money and those great, not only those great, holiday parties, but but they're paying them. So you got payment for order flow. You're talking about the spread, and also like I said to you, like they also trade, they're holding the trade. It's funny. I was doing a class the other day and I was teaching my students. I says, watch when I place a trade out there on a direct access system, and watch how the brokerage firm out there that's doing it is not going to show the order. And then when I get executed, it goes down, watch him jump on the bid. And I had to show like 10 different times to show it. And I mean, I knew exactly what they're doing because I was a marketing. So what I used to do, but they know, like, they will never trade. Like, they have to protect, they have these algorithms, and, and I just show them how they do it. And they're like, oh, and that's how they make their money. And like, listen, there's nothing wrong with it. I mean, just like, listen, like you said, there's no such thing as free lunches, but unfortunately people think that there is. Now, getting back to, let's talk about the success rate of what's going on with commodities. With everything that's going on with the market, what have you been seeing, and what are your traders have been focusing on? What industry? I know oil took a huge run, got crushed after this whole Iran stuff. I mean, some people want to know, like, how do I trade oil, or anything else, or how do I get into gold? Took off. I mean, how do I get into it? What have you been seeing, and where the market's going after what's going on with this war and everything else?
Yeah, so the gold and oil markets have been very, very interesting the last couple weeks, obviously, and we've been pretty active in those markets. Believe it or not, we our big picture coming into the year was we were bearish oil, and we knew, like, when oil's dribbling lower, there's always a risk of something happening in the Middle East, something, upending that. But we were confident that the trend would remain lower, even if we had some noise. And so what we were doing is we were positioning ourselves with limited risk plays. Like, for example, we had some put butterflies, we had some long puts, just in case the market kept going lower as we expect. We're looking for $48, $50, and that projection hasn't changed, even with all this chaos going on. Now, I know
Oil's going to go that low.
What's that?
You think oil is going to still go that low?
I do think so, yeah.
Wow.
We're really well supplied in oil, and I think the US dollar's got a pretty good chance of turning the corner somewhere between 97 and 95 on the index. And if that happens, it's going to be game over for oil bulls, at least temporarily.
Because I listened to the CEOs of Chevron and stuff. They said they could still book a profit at $50 a barrel, but like 45, are they going to be losing money then, you're saying? Like,
so it's tricky because shale oil's cheaper than, shale oil is actually a little more expensive than offshore oil. I would say on average, they're probably looking at somewhere between 50 and 60 for cost of production on most of their oil. Some French producers in the Middle East can make money on $20 or $30 oil. So we can't, even though we're the biggest producer in the world, we have to be mindful of the fact that other people can produce it a lot cheaper than we can. And so there's no, the market cannot, it can go below the cost of production. We see it all the time. In fact, we've seen crude oil go zero and below zero in the last 5 years. So there really is no bottom.
Crazy. I remember that day.
Yeah.
How does that work?
Well, it was obviously it was a situation. COVID shut down. The whole world stops using oil all at the same time. And there's nowhere to store oil, right? So if suddenly we're not consuming it, we don't have any storage, there's nowhere for it to go. So people were actually paying other people to take delivery of oil because they didn't know what else to do with it. So it's just kind of an odd situation, but I'm not expecting that. But I do think 48.50 is in play. And again, I can't see the future better than anyone else. We're just guessing. But this is based on everything that I've seen and everything I've learned over the last 20 years. This is what I think is most likely to happen. And so what we did, obviously our long puts and our butterflies didn't really pan out, but they were limited risk, they were low risk, no big deal. But then when the market exploded higher, we were able to take advantage of the volatility. So we started selling calls, we started buying puts, and we actually pulled off at least half of our position yesterday, and we did just fine. Now, was it a little stressful over the weekend? Absolutely. It wasn't necessarily comfortable, but we try to let the market tell us how to play it as opposed to just trying to maximize profits and hope for the best. And what I mean by that is when the market was low and volatility was low, it didn't make sense to try to sell calls because you were just putting yourself in a situation where if something in the Middle East did happen, like it did, you'd just get completely run over. So the idea is if you are going to trade options in a manner of option spreads where you're selling premium to buy options, you want to make sure you're only doing it if the environment is conducive for that. So you only do that in a higher volatility market. You never do it in a quiet market, or you're just going to get, at some point, you're going to be in the wrong place at the wrong time, and you're going to really regret that.
Yeah, you definitely learn the hard way. You don't want to do that.
Sure.
Carley, just really quick, I love dealing with small shops like yourself. Like I'm talking like the big ones. I mean, obviously, everyone's always thinking about, oh, I just opened an account with Schwab. I could do everything on Poorhouse. But like advisories obviously do help, and you have educated people explain to you. So, if somebody wanted to get started in the commodity trading business, I mean, listen, there's so many things you could trade, right? There's lumber, there's metals, right? There's copper and stuff like that. Like, if somebody wanted to get into it, what do they need to do to understand what they're doing in commodity before they actually do their trade? What do you tell them what to do?
Well, we generally advise people to start small, maybe play around with micros. There's micro futures in gold, crude oil, most of the grains now. So the micros allow them to basically almost kind of quasi paper trade, but with a little skin in the game, because this is an emotional game. I've talked to traders that paper trade for 10 years and they make all this money paper trading, and then they go live and it doesn't work because emotions are really what's driving the ship. So we generally point people towards micros. And I will also say, I talk to a lot of retail traders, and they all say the same thing. They look for the lowest commission and then they open the account. But the reality is this is a different ball game. You do need help. You eventually will need help. Even if you're trading online and doing fine for a year or so, when something goes wrong, you're gonna really wish you had someone on the other end of the phone. And what I mean by that is maybe you're in a commodity that goes limit up or limit down and you don't know what to do. Maybe you were in the wrong place at the wrong time and you have a margin call. Maybe your computer platform or your trading platform has gone out and you need someone to talk to place a trade for you to get you flat. Those types of things can be very, very expensive if you don't know what you're doing. And so even if you have to pay a couple more dollars in commission to trade with a firm that can help you if something goes wrong, it's going to be money well spent, because in the long run, you really get what you pay for.
No, I tell everyone, my broker that I use, that my active trading account, I pay them. You know what I mean? And I don't pay a lot, but like I pay a couple of dollars. But some people, I mean, I know everyone has to eat, right? But but I always kind of use this metaphor, Carley. I tell everyone, if Billy Joel is playing here in New York and he's at Madison Square Garden or in Central Park, where would I go? Okay. Central Park is free. Madison Square Garden costs me money. I'm like, everyone's gonna say, I'd rather go see it for free. I'm like, yeah, good luck. Let me know how that works with you. When you go on that, first try to find parking, deal with all the bums there, deal with every Tom, Dick, and Harry, and whatever it is. I'd rather pay $10 and know that I dealt with security and I got in and then I got my tick seat, than worry about being there. And that's like a brokerage account. Like some people realize, like, you're just another number. They're trying to make your money on you, and it's going to cost you somewhere down the road if you don't have that service out there. And I'm telling everyone, it's just not you and your company. This goes with every brokerage firm. Anyone here is looking for a brokerage firm. These things that you have to ask these questions, because I always get when we always talk to somebody, we always want to know who's your broker and find out, well, why are you dealing with them? Like you just said, oh, they got good ticket rate. Well, you know what? That's not a good trader. You know what I mean? That's not a good trader. If that's the case, then why you own a car? Why don't you just deal with public transportation? Try
Yeah.
to explain to pregnant wife that when she's having labor. Well, I have to wait for the bus to come. You know what I mean? Like, because I don't want to pay for the car. Listen, you get what you pay for, all right?
You absolutely do. A couple examples of that. There's this one client that I had talked to for 5-6 years. He was trading at a discount firm. And it took me that long to I don't pursue people. I don't call and solicit or anything, but he'd been calling in and asking about open account for years. And he was trading a sizable amount of money. And he finally opened, and the very first order he submitted, he did it himself. I didn't execute it for him. He submitted a market order for a 20 lot in copper options. Just the slippage on that order probably cost him 10 grand. And he had no idea. He'd been doing this for years and years, thinking he was saving $2 in commission, costing himself tens of thousands of dollars. It's crazy. So you'd really be surprised at how much you can save if you could just get a little bit of guidance on the nuances of the market and the efficiencies and things like that. Some clients will mention to me that, listen, my commission's starting to add up a little bit. And the first thing I say to people is trade less. You're paying a lot of commission because you're trading a lot and you're losing money. Trade less. You're actually probably start making money, because the problem is people get bored. They think they have to be doing something, so they just start clicking around. But the reality is the people that are making money are trading less, not more.
Yeah. Well, listen, and sometimes that's the only way you're really going to learn, Carley, is you have to kind of analyze. I don't even know what I pay in commissions because I don't look at it. I look at the bottom line is what I made at the end of the day. That should be the least of your problems. Off the top of your head, and then obviously this is not like the old days, like when I traded back in the 90s, we had to pay $20, $25 a ticket in and out, and we had fractions. Now, I mean, what is $3? $2. I mean, it's not cost you anything. I mean, a lot of it is exchange fees too. Like, a lot of people don't realize, even in the stock market, we have these ECN fees, and people are like, what's that? I'm like, well, how do you think ECNs make? How do you think they make money? You think they do it for free? Well, they give it to me free, and then like anything else. But I'm glad that you brought that up, and that's why we wanted to have you here and explain to people, because this is why someone's looking to open up a commodities brokerage account, whatever it is, why they should be looking into somebody like you, or educate yourself before they just deal with see that nice little billboard on the side of the street. But Carley, thanks for coming. And by the way, if anyone wants to know a little bit more about Carley and the brokerage firm that their brokerage firm, just we'll post this QR code up here on the top screen, and we'll have her come back and maybe do a little training, a little session about how to, what is a good account, how to open up a good account, what is it. Just take your phone, scan that QR code, and we'll get you back. Any last minute advice you can give Carley before we go?
All I can say is less is more. Always trade beneath your means and be patient. Patience is really the number one factor between making and losing money.
Well said. And thanks for coming, everyone. Thanks for another episode here. And if you're at Cyber Traders, and if we'll have this up and running for everyone to get the shorts. We'll have the highlights of it. We'll have a couple of 10 little shorts so you guys can watch it. We'll have the long version on our YouTube channel. So just make sure you like us, friend us, and we'll see you back next week. Thanks for listening, everybody. Carley, thanks for being here. Thanks for coming up early for us, and we'll look forward to having you back.
Thanks a lot.